Ladies and gentlemen, close every tab, put down your phone, and give me your absolute attention. Because what I'm about to show you is not market volatility, it's not investor fear, it's not even economics in the way you've been taught to understand it. What you are watching right now is a controlled demolition. The silver price on your screen says $18, 18, neat, clean, comfortable. And that single number has convinced millions of people around the world that silver is cheap, unwanted, and broken. But here's the first uncomfortable truth. That price only exists in one place on Earth. It exists inside a narrow artificial window known as the US dollar paper pricing system. Step outside that window, just one step, and the illusion collapses. Because while your screen says $18, real buyers are paying $108 in the United States and as high as $136 in China for physical silver. Not futures, not ETFs, not exposure, real metal, in hand. So the first question you should be asking is not, why is silver down? The real question is, why are there now multiple prices for the same metal in the same world at the same time? The lie of one global price. You've been told there is one global silver market. That's a lie. What actually exists today are two completely different markets pretending to be one. On one side, you have the paper market, COMEX futures, LBMA forwards, unallocated accounts, synthetic exposure. This market trades promises, contracts, IOUs, silver that mostly doesn't exist. On the other side, you have the physical market, coins, bars, industrial supply, vault withdrawals. This market trades reality, and the connection between these two worlds has been severed, quietly, deliberately, and with extreme precision. The moment the fracture became visible. For decades, the system worked because most people never asked for delivery. Paper silver was enough. Charts were enough. Exposure was enough. But something changed. Industrial demand exploded. Solar panels, EVs, military applications, AI infrastructure, electronics. Silver is no longer just a precious metal. It's a strategic material. And the physical market started doing something very dangerous. It stopped cooperating. Dealers began refusing to sell at paper prices. Premiums exploded. Wait times stretched into months. Inventories vanished. Meanwhile, the futures price kept falling. That's when the fracture became impossible to hide. $18 on the screen, $108 at the counter. Let me be very clear about something. If silver were truly worth $18 an ounce, you would be able to buy unlimited physical silver at $18. You can't. Not in New York, not in London, not in Dubai, not in Shanghai. In the US, real buyers are paying triple digits. In China, even more. So which price is real? The one on a screen, or the one people are actually paying? How the price is really set? Silver pricing is not discovered by supply and demand. It's discovered by leverage. For every single ounce of physical silver available, there are anywhere from 100 to 300 paper claims. That means the price you see is set by the most leveraged market on Earth. A market where selling pressure can be created with a keystroke. A market where unlimited contracts can be dumped in seconds. A market where no metal needs to change hands. And that's exactly what's been happening. This is not a crash. It's a suppression event when silver drops suddenly. Always ask how it dropped. Was metal dumped onto the market? Or were contracts dumped during thin liquidity, outside market hours, in perfect synchronization? Because real sellers don't behave like that. Only institutions trying to force a price do. And every time the paper price collapses, physical demand surges. That's not a coincidence. That's a pressure valve. Why the system needs silver to stay cheap. Silver sits at the intersection of money, energy, technology, geopolitics. If silver were allowed to trade freely, it would expose inflation. It would expose currency debasement. It would expose the lie that fiat money is stable. And worst of all, it would reveal that the West no longer controls the physical supply chain. China understands this. Russia understands this. India understands this. They are not buying paper. They are not trading charts. They are hoarding metal. Two markets, one illusion. So now we arrive at the terrifying realization: you're not watching one market move in one direction. You are watching two completely different markets pretending to be the same thing. One market is screaming scarcity, the other is screaming abundance. Only one of them can be telling the truth. And when markets lie, they eventually tell the truth violently. The question nobody wants you to ask. So let me ask you the question the financial media refuses to ask. If silver is really trading at $18 in New York, why is the rest of the world refusing to sell at that price? Why are premiums exploding? Why are inventories draining? Why are industrial users locking in long-term supply? Why does the paper price fall while physical demand accelerates? because the price is not wrong by accident. It's wrong by design. Once you accept that the silver market is fractured, everything else starts to make sense, because fractured markets don't behave randomly. They behave strategically, and nowhere is this more obvious than when you compare New York to Shanghai. The Shanghai signal, nobody can. Silence Shanghai doesn't price silver like the West. It doesn't rely on a paper-heavy derivatives casino. It doesn't pretend that leverage equals liquidity. In Shanghai, silver is priced closer to physical reality. Delivery matters. Inventory matters. Settlement matters. And that's why the Shanghai price has been quietly screaming a message the Western system desperately wants to suppress. A message that says silver is not abundant, silver is not cheap, and silver is not under control. When Shanghai trades silver at a massive premium to COMEX, that is not inefficiency. That is truth leaking through the cracks. Why China is willing to pay more China is not speculating. China is stockpiling. Silver is essential to solar dominance, grid expansion, EV production, advanced electronics, military systems. And China understands something the West forgot. You cannot print metals, so while Western institutions trade paper contracts back and forth, China is locking down supply, long-term contracts, strategic reserves, domestic production incentives, and every ounce they take off the market is one less ounce available to settle Western paper claims. The U.S. mint problem, no one wants to explain. Let's talk about the United States Mint. The Mint does not speculate. The Mint does not trade futures. The Mint buys physical silver, and yet time and time again, it has suspended sales, limited allocations, admitted supply constraints. While silver was supposedly plentiful at $18, that contradiction alone should have ended the debate, because if silver were truly abundant, the Mint would never have a shortage, ever. But shortages became routine. COMEX, the warehouse illusion. The COMEX warehouse system is often presented as proof that plenty of silver exists. Look closer. Eligible silver is not for sale. Registered silver is shrinking. Withdrawals are accelerating. And most importantly, warehouse silver does not belong to the exchange. It belongs to entities that can, and increasingly do, remove it. Every ounce withdrawn tightens the noose. Every ounce removed exposes how little metal backs the mountain of contracts. The leverage time bomb. Here is the core problem the system cannot escape. The paper-silver market only works if most people never ask for delivery. But industrial users must take delivery. Sovereign buyers must take delivery. Mints must take delivery. And that demand is growing, fast. When delivery demand rises faster than new supply, leverage becomes lethal. At that point, the market has only two options. Allow price discovery, suppress price to control behavior. They chose suppression. How suppression actually works. Suppression is not about keeping prices low. It's about managing perception. Smash the futures price during thin liquidity. Trigger technical breakdowns. Force weak hands to sell. Create the illusion of collapse. Meanwhile, physical premiums rise, inventories drain, delivery delays lengthen. The disconnect grows wider. Why the media plays. Along financial media is structurally incapable of telling this story, because acknowledging it would mean admitting markets are not free, prices are not honest, benchmarks are compromised, and that would trigger a crisis of confidence far bigger than silver. So instead, you get speculators lost interest, rates pressured metals, risk-off sentiment, none of which explains why people can't buy metal at the quoted price. This is not about silver. Alone silver is simply the weakest link, the canary. What's happening here is a stress test for the entire paper-based commodity complex. If silver breaks free, gold follows, energy follows, food follows. And suddenly, the dollar-based pricing system is exposed as a confidence game. That is what must be prevented at all costs. Why the price smashes are becoming more violent. Notice the pattern. Each smash is sharper. Each recovery is faster. Each physical shortage is worse. That's not strength. That's desperation. The system is burning a credibility to buy time. But time is exactly what it's running out of. Two prices cannot exist forever. No market in history has sustained a permanent split between paper and physical. Eventually, one must dominate. Either physical supply floods the market and crushes premiums, or paper credibility collapses and price resets violently higher. There is no third option. And every action taken by the system suggests they know which outcome is coming. The silent panic behind closed doors. You don't see panic on CNBC. You don't hear it from analysts. But behind the scenes, contracts are being rolled, not settled. Deliveries are being delayed, not denied. Allocated metal is becoming harder to source. These are classic signs of stress. This is what a controlled takedown really means. A controlled takedown is not about destroying the market. It's about resetting it on new terms. Flush out retail, discourage participation, consolidate physical supply into strong hands, then reprice. That's how resets always happen. Quietly at first, violently at the end. The clock is ticking. Every ounce removed from Western vaults accelerates the timeline. Every premium spike tightens the constraint. Every Shanghai print above COMEX is a warning flare. The market is telling you something. The question is whether you're listening. To understand why the silver market looks broken, you have to understand who built it this way. Because systems don't fail like this by accident. They fail when they are designed to bend, not to hold. At the center of this structure sit the bullion banks. Who the bullion banks really are. Bullion banks are not traders in the traditional sense. They are market makers, derivative dealers, custodians, clearing agents. They sit between producers, exchanges, governments, and investors. And most importantly, they are allowed to create paper silver without owning physical silver. This is not a loophole. It is the foundation of the system. Silver leasing, the first layer of illusion. Silver leasing sounds harmless. A central bank or large holder leases silver to a bullion bank. The bullion bank sells it into the market. The borrower promises to return the metal later. On paper, the silver still appears as an asset. In reality, it's gone. And this is how 1 ounce becomes 2 claims. The original owner still lists the silver. The buyer believes they own it too. Nothing explodes until someone asks for delivery. Rehypothecation, turning 1 ounce into many. Leasing is only the beginning. Through rehypothecation, the same ounces, pledged multiple times, used as collateral, counted in multiple balance sheets. By the time the system is done, a single ounce of silver can support dozens of claims. This works only if trust remains intact, delivery demand stays low. Both conditions are now breaking down. Derivatives, the ultimate price weapon. Futures, options, swaps, and forwards are not neutral tools. They are price control mechanisms because derivatives allow enormous selling pressure without requiring physical supply. When bullion banks need to cap price, they sell massive futures blocks. They trigger stop-loss cascades. They crush momentum all without touching real metal. The physical market feels the pressure, but receives none of the supply. The trap for industrial users are not speculators. They need silver to operate. So they hedge, they lock in prices, they trust the benchmark. But what happens when the benchmark no longer reflects reality? You get contract disputes, renegotiations, emergency sourcing. And behind closed doors, something dangerous begins. Producers start questioning the system. Producers are waking up. Mining companies don't like selling below replacement cost, and many silver miners are now doing exactly that. Rising energy costs, rising labor costs, rising environmental compliance, falling paper prices. That math doesn't work. So miners are doing what rational actors always do, withholding supply, selling directly, demanding better terms. This tightens the physical market even further. The short position. No one wants to discuss bullion banks are structurally short silver, not because they hate silver, but because the system requires it. Their books depend on rolling contracts, cash settlement, confidence. If price rises too quickly, the short position becomes unstable, and that's when suppression intensifies. Why price must fall during crisis? Here's the paradox. In a real free market, crisis drives metals higher. In a paper-controlled market, crisis drives paper selling. Why? Because rising silver exposes systemic risk. So during financial stress, margin calls, forced selling, futures are dumped, volatility is weaponized. The goal is not profit. The goal is containment. Cash settlement, the final escape. Hatch, when delivery becomes inconvenient, the system offers cash. Premium cash. Enhanced cash. Anything but metal. Cash settlement is the pressure release valve. But every time it's used, it teaches the market a lesson. The metal isn't really there. The moment confidence breaks. Markets don't collapse when they run out of assets. They collapse when they run out of trust. And trust in the silver market is eroding. Not loudly, not publicly, but steadily. One delayed delivery at a time. One forced cash settlement at a time. One unexplained premium spike at a time. Why this cannot be fixed. Gradually. There is no smooth repair for a system built on leverage. You cannot unwind 100-to-1 claims gently. You either inflate away the promises or reprice the asset. History shows which option is chosen. The setup for the reset. Every suppression event is clearing the board. Weak hands exit, physical consolidates, contracts roll forward. This is not chaos, this is preparation. The illusion of control. As long as screens still print prices, as long as contracts still trade, As long as confidence remains just high enough, the system survives. But survival is not stability, it's delay. What happens when one big player demands delivery? The nightmare scenario is simple. A large, credible entity demands metal, not cash, and refuses to roll. At that moment, warehouses drain, spreads explode, price decouples. The reset becomes unavoidable. This is why the pressure is relentless. Suppression must continue not because it works, but because stopping would expose everything. And that's the trap. The deeper the suppression, the more violent the release. The end game is not zero, it's repricing. The goal is not to destroy silver. The goal is to reset it at a level that reflects reality after control is regained. And by the time that happens, access will not look like it does today. Every manipulated market ends the same way. Not with an announcement, not with an apology, but with a moment where the system simply fails to respond. A bid appears, and there is no offer. That is how price discovery returns. The illusion holds, until it doesn't. For years, the silver market has survived on confidence alone. Confidence that contracts can be rolled. Confidence that metal can be sourced. Confidence that cash settlement is just as good. But confidence is not infinite. It erodes quietly, then disappears all at once. And when it does, the paper price becomes irrelevant. What the reset actually looks like. The reset will not arrive as a single explosive candle on a chart. It will arrive as absence, no offers at quoted prices, dealers pulling inventory, exchanges widening spreads, technical issues delaying settlement. At first, it will be explained away. Then it will be impossible to ignore. When physical becomes the benchmark. In the aftermath, pricing power shifts away from futures exchanges, synthetic benchmarks, dollar-settled contracts, and toward immediate delivery, regional supply, strategic buyers. Silver will no longer be priced by promises. It will be priced by possession. Why the price must reprice higher. This is not speculation, it is arithmetic. Years of suppressed prices have discouraged exploration, reduced new supply, deferred investment. At the same time, demand has become structural. Green energy, electrification, defense, technology. You cannot reconcile those forces at $18 or $30 or even $50. Repricing is not optional, it is mandatory. The winners will not be who you expect. By the time the reset is visible to the public, physical access will be limited, premiums will be extreme, participation will be restricted. The metal will already be in strong hands, institutions, sovereigns, industrial users, not because they are smarter, but because they acted before permission was required. The new rules after the reset. After the reset, leverage will shrink, contract terms will tighten, delivery requirements will harden. The era of unlimited paper, silver will end, not because of reform, but because reality enforces it. What this means for the dollar system. Silver is not isolated. It is connected to confidence in fiat currencies, debt markets, monetary policy. When silver reprices honestly, it signals something deeper. The cost of real assets has been understated for years, and that realization will not stop at metals. Why authorities will claim victory. When the dust settles, you will hear markets normalized, stability restored, reforms implemented. But stability achieved through repricing is not stability. It is admission. An admission that the old system could not hold. The psychological shock. Most people will not understand what happened. They will only know prices jumped, access vanished, narratives changed, and they will be told it was unforeseeable. It wasn't. The signs were everywhere. The role. Silver played. Silver exposed the limits of control. It revealed that leverage cannot replace supply. It proved that physical reality always wins. That is why this market mattered. This was never about getting rich. This was about preservation, about understanding how systems behave under stress, about recognizing when a price is a signal, not a fact. The final irony. The same system that suppressed silver to maintain confidence will eventually point to silver's repricing as proof that markets still work. That is the final irony. What remains? When the noise clears, when the charts stop moving, when the headlines move on, when the panic fades, only one thing will remain true. Silver was never cheap. It was only mispriced. The market will not warn you again. This divergence will not repeat. Once physical becomes the benchmark, the opportunity disappears, not gradually, but instantly. The quiet ending. There will be no bell, no announcement, no ceremony, just a moment when the old price stops mattering, and a new one takes its place. And that is how rigged markets. And not with exposure, but with replacement. The old price is forgotten, the new price is accepted, and history moves on. Final thought. If you've made it this far, understand this. You were never watching a crash. You were watching a transition. And transitions don't ask for permission. They happen,